So when should you time tax loss harvesting? At a minimum, you should evaluate your portfolio, tax loss harvest, and rebalance at least once a year. But the most tax efficient investors tax loss harvest more frequently throughout the year, especially during volatile markets. Why? Because volatility creates opportunities. Whenever there's unexpected volatility in the market or with one of your stocks, this is the perfect time to tax loss harvest. Even when the S&P is up 20%, individuals in your stocks in your portfolio could be down. These are your opportunities. Market dips generate losses you can harvest. The more frequently you monitor your portfolio, the more opportunities you'll find to harvest losses and use them strategically. Of course, you always want to buy low and sell high, but inevitably, you will always have unexpected losses. So, the continuous rebalancing advantage. Here's how rebalancing frequency impacts your tax savings. So, annual rebalancing, you might find $5,000 in losses once a year. Quarterly rebalancing, you might find $8,000 in losses across multiple opportunities. And more continuous monitoring, you could harvest $15,000 plus in losses by capturing every market dip. Of course, these numbers will be different for every person. Each dollar of losses harvested, though, is a dollar of gains you can eventually sell tax-free. So over decades of investing, this compounds into serious tax savings. So a real-world example. Imagine you have a $500,000 portfolio that's 80% stocks, 20% bonds. You want to rebalance back to 70% stocks and 30% bonds. This means selling $50,000 in stocks. The costly approach is to sell $50,000 in your biggest winners and pay $10,000 plus in capital gains taxes. The tax smart approach, ideally you've been opportunistically tax loss harvesting over time, in which case you've been able to harvest $20,000 in losses from underperforming stocks during market dips. This enables you to sell $20,000 in gains tax-free, offset by your harvested losses. Number two, you should consider selling some funds in your IRA, perhaps $30,000 from your IRA tax-free. And you can always use new contributions to buy bonds to help balance as well. So the result, the same rebalancing outcome, but you just save $4,000 plus in taxes and still have losses banked for future use. So the bottom line, the best time to sell gains is when you have losses to offset them. So be patient, stay disciplined, and let tax opportunities come to you. Over a lifetime of investing, this tax-aware approach can be worth hundreds of thousands of dollars in additional wealth. Advisement is being built automatically exactly for this. We'll continuously monitor tax loss harvesting opportunities and optimize your rebalancing to minimize taxes every step of the way. Stay tuned.